Hello and welcome to our latest investment update as of June 19th, 2020. I am Mark McCarron, Wescott's Chief Investment Officer. In this week's edition, we will provide an update on the markets and the state of the economy as we typically do. We will also spend a little more time looking at how other asset classes outside of the stock market have fared this year, but also over the long term. Each asset class plays a specific role in your portfolio, and an important role in delivering expected returns at the specific level of risk or volatility. And then finally, we'll end today's update with an outlook. So first, an update through June 19th. Governments around the world continued to relax lockdowns, and this is an effort to reopen the economies. This has helped the job market. In fact, the US job market is improving, but millions are still receiving unemployment benefits, which suggests that we have a long way to go. In addition, as the economy opens, cases of the virus continue to rise. However, we don't think another global lockdown is very likely. And there's a couple reasons for that. First, we're learning more about the virus. Second, we have improved our testing capability and capacity within the US. And there is progress on treatments and vaccines, which is great news. And we will continue to observe social distancing measures. And all of this has really helped the market, as we talked about in previous webinars, recover. The continued broad recovery has gone through this past week. We're showing here the S&P 500, and as we introduced a couple of weeks ago, the S&P 500 equal weight, which is a broader measure of the US stock market. And if you look at the blue line, which is the S&P, it's nearly erased all of its losses for the year. In fact, it briefly did last week before a sell-off as virus cases spiked. However, that was short-lived, and we're back moving higher again. The S&P 500 equal weight index remains quite volatile, but has also improved dramatically in the second quarter. And that, the difference continues to be the difference between economically defensive stocks and sectors versus those that are much more sensitive to the economic recovery. And so in this webinar, we want to spend a little bit more time thinking about the components of a broadly diversified portfolio, not just the stock market like we've seen and highlighted before. And so when we talk about the markets in general and the media, they tend to focus on the popular indexes like the Dow Jones or the S&P 500. But your portfolios are broader than that. On this slide, we highlight 4 major asset categories that can be used to construct a well-diversified portfolio. While we don't have time to go through each in detail on today's call, we wanted to highlight some of the key features of each and their role in your portfolio. For example, on the equity component, the role of equities is to generate significant capital appreciation over time. In addition, it's an asset class that generates both growth and income through dividends. We've highlighted here something called a patience premium. Unfortunately, equities are the most volatile asset class, and you need to be patient through periods like this to really accept and benefit from the long-term return associated with the asset class. And just from some examples, US stocks, non-US stocks, emerging markets, and in particular investment styles. So value and growth, large and small. These are all examples of different types of investment stocks within investment style, and each of them have their own risk return profile. Second, we want to talk about fixed income. And the role here is really to generate income, but also, very importantly, diversify equity risk, as we've seen this year. And then finally, the credit premium. What we mean by that is if you go invest in the fixed income market and are willing to go down in quality a little bit, you should be rewarded for that. In certain environments, that's rewarded. In today's environment, with yields as low as they are, going down the risk spectrum doesn't necessarily generate that same premium. It's important to look at that when building portfolios. So some of the examples in the fixed income market include government bonds, corporate bonds, mortgage-backed securities, and of course, municipal bonds. We don't tend to spend too much time on the other two categories here, but real assets, things like real estate, natural resources, gold and silver, real estate investment trusts, these are very important components of a portfolio because they also generate income, but they also provide a very significant inflation hedge because rents tend to be linked to inflation. So as inflation increases, so too do rents. So it's a very attractive asset class. The real asset premium, as we're talking about today, is really this idea of holding an asset like a commercial property or other real estate and generating significant income from rental income, but over a long period of time. And that's different from holding a portion of a company via the stock market or investing in the debt of a company in the bond market. Then finally, the role of alternatives. So what we mean by alternatives include things like hedge funds, private equity, listed private equity, and private lending. But we won't go into all those specifics, but in general, the role of an alternative asset allocation is to protect the downside risk of a portfolio, is to generate return that's uncorrelated to that portfolio. And in general, if you're willing to give up your capital for a period of time, you should be rewarded for that. That's what's called illiquidity premium. In other words, you don't have access to your capital every day, but with that give up, you're expecting a higher expected return over time. So what we thought we would do is take a little look at what these different asset classes have done this year and over the last 10 years. So in this section of the chart, we're showing the return of large cap stocks, small cap stocks, US bonds, real estate, commodities, and hedge funds. So we've been really focused on the stock market, which is really this one category, but there are a whole bunch of other categories that we're looking at here that represent alternative asset classes and play important roles over the long run. As you can see this year, the only asset category that it's in positive territory are US bonds, up 6.1%, outperforming all equities, all commodities and real estate, and even hedge funds. Hedge funds are a mix of different strategies, but in general, they're down about 3% this year and outperforming other asset categories like small cap stocks and real estate and commodities, but not keeping up with the bond market. In general, what we find with hedge strategies in general is that they fall between stock market returns and bond market returns, i.e. providing a little bit of a downside protection in the most volatile markets, such as the one we're seeing this year. But it's important to look at over the long term. The 10-year return of US stocks has been very, very strong at 13.1%. Small cap stocks also very strong at 9.4%. Bonds, although the best performing this year, or year to date anyway, the longer term 10-year return of 1.8% is a little bit more, a little closer to our expectation, meaning it's not a return generating asset, but an income generating asset and a good hedge against market volatility. Real estate's been a very strong component of the market. Commodities have been very weak this year specifically, pulling down the 10 years, and hedge funds have been a good positive alternative source of income and return. So all that said, it's important to look beyond just the US stock market, the other asset classes, particularly US bonds this year, and over the long term, real estate and hedge funds all provide a return pattern that's different from US stocks and a nice complement over the long run. And now we want to go even further back. So we looked at a year to date, we look at a 10-year, but let's look at a nearly 100-year track record of some of these asset classes. So US small cap, for example, $1 invested back in 1926 would be worth $25,000 today, a very significant return on that asset category. Yet, as we just talked about this year, small caps have underperformed large caps, not only year to date, but also the last 10 years. but we still think that they're a very good component of a client portfolio to be allocated to. The other line on here is the S&P 500, which represents U.S. large company stocks. A dollar invested back in 1926 would be worth $9,000 today. And we can continue to work down. What's generally expected is that long-term bonds, while generating good income, don't generate as much return overall as stocks. But at the same time, they're less volatile. So importantly, we want to have a combination of both of these major asset categories as a core component of a client portfolio. And both of these, over the long run, generate more return than cash and inflation, which is really critical because that's your spending power. That's your real return after adjusting for US inflation. So with that, we wanted to give you a bit of background as to why we have asset classes that are going beyond just the US stock market. Our outlook continues to be that portfolios benefit from the broad asset class diversification over the long term. And despite the strong second quarter 2020 rally that we've seen thus far, and as we go back to the chances of a second wave of the virus, we still remain positive on equities, particularly over the long run. We've seen how equity markets are more volatile than all other asset classes, but have generated and will continue to generate, in our view, better long-term returns. However, the fact that we have growing economic and political uncertainty ahead does support a balanced approach that includes all of the asset classes we talked about in today's webinar. So with that, and as usual, thank you for joining us. Thank you for your trust and confidence in us. Please do not hesitate to reach out to me or your advisor with any questions.